US consumer prices increased by the most in 7 months in November. Welcome to Market Insight. I'm Elena Casas. The consumer price index rose 0.3% month on month. That's the biggest gain since April, but it was in line with estimates, and it has cleared the way for a Fed rate cut next week. That's now seen as 96% likely by the Fed funds futures markets, although the potential impact of incoming President Donald Trump's promised tariffs make rate moves next year harder to forecast. Well, for more, I'm joined now by Garrett Melson, portfolio strategist at Natixis. Garrett, hi. In today's inflation report, then, is there anything that should concern markets?
Yeah, well, it certainly is continuing the trend of slightly warmer prints. This is now the fourth print in a row, rounding to about 0.3% on a monthly basis per core. So after a lot of progress over the last 18 months or so, it does feel like we've stalled out a little bit. That certainly is the narrative. But under the surface, I think the details are still encouraging. There was a very big downward movement for rent and shelter prices. That was offset a little bit by some housing items, a little bit warmer on the used and new vehicle front. And then also another uptick coming out of hotels. So I think the big story is under the surface, the big items that have been falling continue to fall. And the question for me is what really continues to see some of these stickier items, or I guess the little fly in the ointment for some warmer items, keep pushing higher? To me, it looks a little bit more idiosyncratic in nature. And the underlying trend, I think, is still intact to continue cooling back towards the Fed's target.
Well, the market is clearly priced in a cut for next week, but how do you see the Fed's path going into 2025?
Yeah, I think the cut for next week was already baked in. This certainly affirms that. At this point, I think it boils back down to the fact that we are continuing to see progress back to the Fed's target on the inflation mandate. But on the labor side of the mandate, the risks, maybe they're not quite as extreme as we thought a couple months ago. We've seen some signs of stabilization in the labor markets, but risks are still very much skewed to the downside. And in the Fed's opinion, we're still in restrictive territory. So I think the bias to continue easing remains in place. That's the big story. The question is whether we continue the same pace of recalibration. I think that's where the markets are really already pricing an every other meeting type cadence into next year. So we're already pricing basically that skip for the January meeting and then another cut at the following meeting here. I think that's basically the right idea, and markets are somewhat fairly priced. But to me, if you were to ask me what the risks are, I would say the risks, again, to the labor market are still skewed to the downside. And I'd say there's some risk that maybe you'd see another incremental cut and maybe even need to pull forward that timing. But right now, from how we see the outlook, I think the markets are somewhat are reasonably fairly priced in terms of the rate backdrop.
In the markets, Garrett, we've seen this spectacular run-up since Election Day, which, as you pointed out, mirrors 2016. But then much of the Trump bump had faded by Inauguration Day. Could that happen again?
Yeah, I think this is what we've seen in markets is a lot of investors just rolling back that same playbook. So you take a look at what trades have worked. It's certainly been the U.S. over the rest of the world, small caps over large. The dollar has certainly seen it quite a bit, rates selling off, and some of the cyclical sectors rallying as well. So that's been a trade that's really been in place basically going back to the beginning of October, even mid-September. And I think it's twofold, right? We were pricing in excessive recession risks in early and mid-September. So some of this rally and some of the so-called Trump trade, I think, is just simply a reflection of stronger data. But it certainly does appear like investors started rolling out that playbook early on. And now I've heard quite a few refrains that, this is kind of a clear runway into Inauguration Day. Perhaps the pain trade is that we've seen already a lot of front loading of those returns for some of those Trump trades. And now we're looking at a rotation. And it certainly seems like in the last week or so, we're starting to see some of those cyclicals fade a little bit here. Even when you look at some of the European trades starting to catch up a little bit, but it's all about tech over the last week or so. So, the broad backdrop, I think, remains supportive for some of these trades to remain in place, because I think at the heart of it is U.S. exceptionalism. And I think that's something we talk about on a cyclical basis, but under Trump administration, it really is, I think, more secular. That remains in play, but I think some of these Trump trades that have run quite a bit probably due for a little bit of a breather, and we may have already pulled forward some of those returns from where we sit today.
The economic backdrop, though, is very different from 2016. How could that change the outlook?
Absolutely, and I think that's really at the heart of the Trump playbook is pro-growth. Certainly we have to contend with some tariff risks that maybe not be inflationary in terms of a process, but certainly a price level step higher. But starting points do matter, and so when you think about markets as well as the economy, we're in a very different starting point, right? We don't have the same kind of labor slack. Unemployment rate is certainly much lower. Corporate tax rates are much lower. Valuations are higher, and certainly on the fiscal front, debt to GDP as well as just deficits outright are certainly much higher than they were coming into Trump's first term. So, in terms of the flexibility to push a really aggressive pro-growth agenda, there's not quite that same degree of flexibility for Trump. So, I do think that while the policy mix will probably still skew pro-growth, I think there's somewhat of a limit to just how far and how much juice you can squeeze out of that, just given the different starting points here.
You mentioned the Trump administration's planned high tariffs. What about the potential of a trade war to ruin that soft landing?
Absolutely, and that's the risk. I think the viewpoint for markets right now is very much what we saw again during the first administration, which is take Trump seriously, but not necessarily literally. And so, obviously, we've heard quite large tariffs suggested out there, and certainly to the degree that would prompt some retaliation of some sort from some of these targets. So that's something we need to contend with. I think markets have taken a little bit of a reprieve and some confidence in the fact that Scott Bessent, as Treasury Secretary, has sounded a little bit more incrementalist in terms of how these tariffs would be applied. So not necessarily going straight to the limits of 50, 60% or even higher tariffs, but maybe doing it more so in a measured pace. So ratcheting them up, looking for a response. If there's no response of sufficient magnitude, then keep ratcheting those up here. So that I think is something that markets are taking a little bit of confidence in. But certainly the risk remains that if we do see some tariffs being aggressively ramped up here, there is the risk for some retaliation of sorts. And ultimately, it's not about an environment where anybody really wins. Everybody somewhat loses in the sense that it's a backdrop where you should expect to see some lower growth on a global basis as well as domestically. So certainly a risk that we'll need to contend with as we start to get a better picture of what the administration and the agenda looks like into next year.
Garrett Melson of Natixis, thank you so much for joining us. Well, that's your market insight. Don't forget to watch more videos on Reuters.com.